Welcome back everyone to another episode on Ang's channel. Today, another discussion on the topic is going to be the laziest way to invest in the market. So the laziest way means that the idea of investing is just you really have this capital which you really want to invest it, hoping that it can actually generate returns and profits as also better cash flows. Well, most people don't want to manage a lot of things. They just want to put their money into a certain assets, which set to be guaranteed in terms of percentage returns or certain amount of returns. And then comes to FD, whereby every year they give them 3 to 4%, sometimes 5%, which is quite decent. But then it's not enough to beat the inflation. And then there will be people that come out to say about the long-term investment and compounding, the strength of compounding interest when investing in index. For example, the S&P 500 and the QQQ. The laziest method of investing in the stock market right now, based on my observation, is going to be in the S&P 500, whereby they are data supported, annualized returns of perhaps 8 to 10%, but I would actually say it's actually at 8%. To be a conservative value. So if you were to consider that each year your capital will generate you 8%, and this is the annualized value. And if you will be able to buy at the dip, you will be having what, 10 to 15% because of you buying at the low, and there is high chance or there is higher margin in terms of profits, such as if you buy at the recent drop due to the tariff threats and so on, you'll be able to returns right now around 40%. So this can actually last you for about 4 years. If 4 years later you still own the same amount of money that you earn from here, you will still be able to gain an annualized of return 10% from the S&P 500s, whereby you just need to put in every month, you have to allocate some funds from your salary or whatever your savings into the S&P 500. And with this every month, you will be able to start compounding your capitals. And 10 years later, 20 years later, who knows, you will be able to build up maybe 100K, a million, depends on the amount that you contribute monthly. So this is the what is so-called DCA, which is going to be dollar cost averaging, whereby you already understand that this tools of investment is proof to be able to provide annualized return of 8 to 10% as far as the market has been around. So this actually makes things easier, as you only need to know what is the time to buy. But there is no such definition of when is good day to buy, when is the good price to entry, because somewhat we are human, we are not gods, we cannot actually predict what is the lowest price, what is the highest price. So the best idea is to average your entry time throughout the years. So you'll be able to buy, for example, 10 years ago at the highs and 10 years later at the very lows. So eventually, what is your entry price? You're going to average it in the middle, somewhere in the middle. So for example, if you buy at the highs and you buy some at the lows, so perhaps the average price will be over here. So in the long run, you'll be able to obtain a average entry price, and this will lead to the fact that you'll be able to generate more. And this also hedge against the issue of you buying at the top for once. Because if you were buying at top over here, you would have suffered 2 months of not profits and perhaps 4 to 5 months in order for it to come back to the returns. But if you actually bought again, you actually DCA, you bought at this time and you also bought at this time. So this resulting your average return will be here. So this takes you less than 2 months to recover and actually earn some profits from the market itself. So the idea is to just, in the long run, you'll be able to enter the index or the S&P 500 in different price range. And also, based on the data supported of S&P 500 being able to provide great returns despite any conditions, time becomes its greater friend, whereby in the long run you will be able to generate a lot as well as having that stable returns in terms of ROI. So that is the laziest way of investing in the stock market, which is every month you have a paycheck coming in for $5,000 and you just allocate maybe 10% or 20%, meaning ranging from 500 to 1,000, and you put it inside S&P 500, and you just close the broker, and you keep on living your life, do whatever you have to do, uh, grow whatever you have to grow, learn whatever you have to learn, and then next year when the paychecks come again, this time maybe you earn extra from your side hustles. So maybe another 2,000 from your side hustle. This means you have to contribute additional 200s into your S&P 500s. So it's like putting it inside your saving, but take note that don't treat the investment into the stock market as your saving, because what if you really need that amount, as mentioned in our previous video about risk management, and do not invest first, because you need to gauge the difference between savings or the emergency funds and the investment money. So these are two different portion of cash, whereby one is you cannot afford to lose because it's your final backup, and the other one is whereby you have to risk it, because with greater risk come with greater reward. But of course you have to do your homework and your research before you invest into the markets, as to understand what are you doing with your money, and that is the best way to identify great investments as well as to maintain it. So I guess that is all, because the laziest way is just to put a certain amount or a certain portion of the money into a investment tool. One of the safest way is going to be S&P 500s with proven datas, but there are still a lot of arguments about it's not the best return. You could have put it into properties, or it's not safe. What if you bought at the top during the pre-COVID, and then it just crashed 40%? It takes years to come back. Well, that is the beauty in terms of DCA, as well as friends, as well as time being your friends when you invest in long term, because in the long run you'll be able to achieve, and the longer the time period is, the more stable the annualized return, which is going to stay at maybe 8 to 10% or even higher, depends on whether you actually adjust the allocations of the positions of the portfolio based on your risk appetite. So the next step is going to be starting to identify what exactly is within S&P 500, and you will start to notice that there are some very large holding that the S&P 500 index holds, and those are the major contribution to the price movement of this index. And those large holdings, the reason why they are so large in terms of their shares and as well as the ability to bring returns, is because of their ability in generating cash, in selling their products, the services, which is what we know as a good company. So this is like evolution, whereby you first invest just because you want to make your money work for you, and later on you start to identify a more efficient way in terms of investment. So also throughout the journey you might as well face trouble in such as assuming that the company is actually in very high value or very great company, but it's actually not, due to several factors. But I think that's another story on the other day, and also kind of hard to tell, because just based on the data itself, you can't actually have a full picture of what the company insights is, what's their future view, what they expect them to be at, and what is their strengths, as well as potential growth in terms of their employee, as well as their ideas, their designs, and so on. So it's very it's not static, it's very dynamic, whereby it can change within nights, within weeks, months, and years. But based on the informations that we have right now, it's easy to identify a great company, especially when it provides great returns, profits, ROE, ROIC, as well as having more cash than the debts. So that's the basic idea. And I guess that is all for today's video. I just want to point out the laziest way of investment, because do think that there's a lot of people out there, they wanted to start investment, but they are scared of failing because they couldn't actually decide what is the best company. And despite identifying the great company, they wouldn't dare to enter because of the very expensive price, as well as the idea of what if I enter and it start dropping 50%. So why not just start by investing regularly or every month using DCA method into the S&P 500s. But of course, please do your due diligence as well as research on whatever laziest method in investment. Do your research, understand, get yourself educated, and know what you're doing before you click the button of putting your money into that investment tools. So I guess that is all for today's video. I hope this helps, and if you like the video, you can support by sharing and like the channels. And I'll see you guys on the next one. Goodbye.